But broadly speaking, we are bullish on the human endeavor. We are bearish on the path function. We are bearish in the near term. We're bullish in the long term.
Thanks for joining us for part 2 of our interview with new financial media sensation Doomberg. If you haven't yet watched part 1 of our discussion with the Doomberg chicken, in which he pinpoints the biggest concerns about the precarious status of today's economy, social stability, and financial markets, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Doomberg and I, as well as our partners at New Harbor Financial, share in this video. And please, just take a moment to support this channel by first liking this video and then clicking the red subscribe button below, as well as that little bell icon right next to it. Doing so will help this video reach a lot more viewers. All right, let's get started watching part 2 of our interview with Doomberg. I still have a ton more questions here. I'm not going to get through all of them, but there are a couple of topics that I just would be remiss not to get to with you here. And the big one here is the interdependency between energy and the economy. And from my old prior days at Peak Prosperity, we used to talk about this an awful lot. And I was always just continually shocked by how many people treat the economy and our energy systems as two separate systems, not realizing that you just you can't do anything in the economy without the energy system. They're completely interdependent. In fact, if you map energy consumption and GDP, it's basically like a 0.99 correlation coefficient. I mean, it's about as tight as you can get. So I guess my question for you first is do you share this sort of same being flummoxed that more people don't see this connection, and why don't you think they get it?
So this is the literal market inefficiency that Doomberg hopes to occupy. The connecting of the visceral real-world experience to the physics of the underlying economic activity. Energy is life. The human endeavor is a constant, unrelenting struggle against entropy. And standing still means you die. So you actually have to keep putting more and more energy in just to maintain, let alone grow. And the more people understand this, the more they will see, hopefully, that from a human first mindset, energy policy is absolutely critically important. And if you mess with energy, you mess with life. And what we're seeing right now through this, what we believe is a unfolding energy crisis, people are starting to wake up to that fact. And in fact, I would say 70% of the Doomberg pieces are riffs on that key overarching theme, which is, in the battle between platitudes and physics, physics is undefeated. Ultimately, the laws of physics have to be obeyed, whereas platitudes can be ignored. And this is a real challenge for people. And, just the 3 of the last 4 pieces we've put out have been playing to this theme. We are dangerously short oil production capacity vis-a-vis imminent demand. We play these geopolitical games. This latest piece that we put out called Contortion Nation, where we bemoan the fact that we have to cut unseemly deals with despots like the Emir of Qatar when we have perfectly fine natural gas deposits to exploit in the U.S. and to employ hardworking American families to do so, that have been tied up in court battles for 3, 4, 5, 6 years because we've created this framework of law and this incentives for lawyers to throw wrenches into the wheels of the U.S. American energy infrastructure. That is going to eventually manifest itself in substantial economic disruption. And we view it as part of our job to point these things out, to connect those dots, and to teach the American people and the American investor class the consequences of, for example, starving the U.S. energy infrastructure of capital because of what you think is some ESG mandate.
Yeah, and folks like Rick Rule have been beating the drum very loudly over the past year plus about how undercapitalized CapEx or underinvested CapEx has been very much in the energy sector, but also in a number of key commodity production sectors for a number of years now. Mm-hmm. Yeah, that we're just basically creating future shortages for ourselves because of that. And of course, that you just mentioned sort of this I'm going to call it misdirection of focus because of some of these ESG mandates worldwide. Germany is seeing that in spades, right now, where they basically shut down their older supplies of energy, with a rosy outlook on how they were going to get all this, meet demand and produce more through more sustainable means, and yet they kind of miscalculated, and now they're having to scramble, right? So number of quick questions here. First is, let's start at the high end. Just how screwed is America's energy policy right now? And just talk about it at a high level, but because it's not just underinvesting in CapEx, it's making, just in some cases, really poor decisions. And maybe we can use as a case study New England and the very big problem it finds itself in right now for natural gas supply, where it's got proximity to a lot of natural gas production, but that gas isn't being distributed within New England, and New England's dependent upon foreign imports of natural gas. And of course, now that China in Europe are battling for natural gas, it's the smaller player at that table now.
Yeah, and so we wrote a piece called "New England is an Energy Crisis Waiting to Happen," and we laid all this out for our readers. So I would say that our current strategy is bonkers, and we actually have a piece called "America's Energy Strategy is Bonkers," and we lay out what our strategy would be. Our current strategy is bonkers, and we would argue our long-term outlook is quite good. America has a way of trying all the bad ideas before settling on the best one. And this is just sort of the give and take of politics. We have an unbelievable set of resources. We have very deep ports. We have amazing technology investments. We are frustrated today by the legal framework and the opening that allows rent seekers like teams of lawyers who do nothing but try to delay these projects to soak up fees at the expense of the American consumer ultimately. So today our strategy is bonkers. In the long run, when pushed hard enough and when the crisis eventually materializes, the response will be one that does drive substantial GDP growth and investment opportunities. It's frustrating that the path function requires us to go through all the dumb ideas before we get to the obvious ones. The obvious ones are knowable today. We try to articulate them. And so our main argument is, yes, bullish on oil and gas today for all the wrong reasons, bearish on the sensibility of our policies for all the wrong reasons. But in the long run, we are also very bullish on the American spirit, on capitalism, and on the technological advancements that are being made in the space. And we will come begging hat in hand to the very same investors and workers that we are begrudging today, that we are trying to minimize today because of perverse ESG mindsets. But ultimately, in the long run, we are quite optimistic.
All right, great. Yeah. Your summary there reminds me of a Winston Churchill quote, which is when asked about Americans, he said, "I love them. You can always count on them to do the right thing after they've exhausted every single other potential option." Right?
It's the American, it's the American way.
Yeah, exactly. All right, just making it real for viewers here. Do you expect price and supply to begin mean reverting at all this year, or should people be girding for these shortages and crazy prices to last a lot longer than they hope?
So it's always difficult to call the top in these types of structural changes. We would, it's called Doomberg. We would argue that the worst is not yet behind us. We don't yet see a sufficiently deep crisis. And I would argue that the thing that we're keeping a close eye on, and that's perhaps underreported in the US, it's very much reported in Canada, is this trucker situation in Canada. Overnight, they have blockaded the Ambassador Bridge, which connects Detroit to Windsor and is responsible for 25% of the flow of goods between the two countries, which is, as you know, a very, very critically important trading relationship for the global economy. We would argue that 25% is an underestimation of the number of supply chains that will be disrupted because of our just-in-time supply chain issues. If the situation in Canada does not resolve soon, we think in the near term that the supply chain crises that we've begun to experience because of COVID and the energy shocks, both in Europe and China, are about to become a lot worse. And this could be the seed of the next crises here in the U.S. as all the things that we need. We have this very interconnected NAFTA economy, and if key arteries of the Canada-U.S. land border are disrupted for even a period of several days, we're going to see a cascading series of shortages and empty shelves and manufacturing shutdowns until this sort of crazy policy of the vaccine mandates has changed.
All right. Yeah. So again, underscoring the fragility and the vulnerabilities of our just-in-time distribution system here. There's a book written by a woman named Alex Friedman called "When the Trucks Stop Rolling," and it just sort of does the calculations of how quickly in your local area, certain products start disappearing from the shelves if the supply stops. And it's ridiculous, especially for things like, pharmaceuticals and certain types of foods. I mean, it's like most communities don't have 48 hours worth of supply. Hopefully, this doesn't become, hopefully it gets resolved. The trucker blockade gets resolved soon favorably for everybody, because there's a number of things that COVID inflicted on the supply chains that, we really had no control over. This one humans do have control over, and we're just exacerbating an already bad situation for ourselves. I'm not taking a side here. I'm just saying that I think you're right. This could knock over some dominoes that we would really like not to get knocked over if we could avoid it.
Well, something has to give.
Exactly. All right. So a lot of your pieces, as you've already said here, really do come down to the growing importance of both the availability of natural resources as well as who has control over them. Is this the principal trend of the future? Do you see personal prosperity rising or falling over the next decade? And how worried are you about resource wars ahead?
So over the next decade, I would say rising. I think if you measure things over a period of decade, broadly speaking, that's a pretty good bet. I think there is substantial technical innovations that continuously create deflationary forces that allow us to make lots of mistakes and to cover up those mistakes without exposing substantial drops in the standard of living. We are mostly techno-optimists. I think we're seeing some very exciting things in the nuclear energy space. The oil and gas sector continues to innovate despite being ostracized at every step of the way for the things that they do for the rest of us. But broadly speaking, we are bullish on the human endeavor. We are bearish on the path function. We are bearish in the near term. We're bullish in the long term.
All right. And speaking to the bearish in the near term, at the end of the day, Wealthion is a financial education channel. We have a lot of people here that are trying to figure out, okay, how do I position myself for what's coming ahead here? So if we define our view to say the next year and a half or so, do you have any general recommendations for viewers about how they could prepare both personally and financially for some of the things that you see most likely coming down the pike in that time frame?
Yeah. So one thing is very clear. We personally, as a firm, don't give investment advice, and we're not registered financial advisors, and we take that very seriously. But I can only express to you how we go about doing this ourselves, which is we strive to earn income in fiat and participate in the fiat world. We save money by buying real assets, gold, land, pick your favorite, and then we invest. Personally, we invest in private enterprises where our skills and experience and background can affect the outcome. Sweat equity alpha is the manner in which we set up our portfolios. That's probably not how the average listener of yours goes about things, but it's how we go about things. And so we have very, very small allocations to the stock market. It's very difficult for us to buy things that we think aren't as valuable as they're currently selling for, based on the hope of finding a greater fool to sell it to at a higher price later. And because of that sort of Austrian mindset that runs through the vein of our firm, we tend to focus on, for sure, we'd like to earn in fiat, and we save in real assets, and then we invest privately where we believe we can have a disproportionate outcome and affect that outcome for the positive for ourselves and our fellow investors. And so to the extent that any of your listeners might not have heard that as a mindset, that's how we go about it. And it's very difficult for us to say that Beyond Meat is a short or AMC is along, or Tesla is along at these valuations and these prices. The chasm that has exploded between price and value in the past couple of years have befuddled us, and since we largely don't participate, it's easy for us to not get emotional about it. But this is not a market we would be buying into at these prices. But to be fair, we don't do much buying into the market, regardless of the price, because we have this pre-existing strategy of focusing on sweat equity and alpha that we can derive from that.
Well, that's a great model. And just to repeat for folks, it's earn your income in fiat, convert that fiat into real tangible assets, which you consider your savings, and then to basically get a growth on that savings, invest in private equities that you have A, more direct control over, and B, have some expertise, hopefully, that you can use to your advantage to help that entity thrive.
Yeah.
And a number of viewers probably have some ability to do that. In general, and again, yes, none of this is personal financial investment advice. Are there any sectors out there, given your macro outlook, that you think are likely to do especially well or especially poorly, given the trends that you look at most closely? Like, for example, I would think maybe commodity producers you would think might have a better future ahead of them than, say, some of the more speculative tech stocks.
Yeah, so we don't invest in the Ponzi sector, as Cuppy would call it. What are we interested in? And so first of all, if you're going to invest privately, that requires accredited investor. The single most important parameter to successfully investing privately is deal flow, and seeing the deals that meet your criteria early enough so that you can get in the early enough rounds and then help those companies grow. And so you're talking venture capital, you're talking distress investments, you're talking about private equity. For us, anything that is consistent with this onshoring and investing in the US, and investing in the robustness that we talked about earlier. So we sort of try to put our money where our mouth is. But also there's just many investments that are out of favor today because of these ESG mandates that financially look amazing. And that a big swath of the people who invest because pensions have allocated resources to them can't participate in. And that's can be enormously successful if you can find the right management team, the right opportunity, the right business plan, and importantly, your ability to consult with, improve upon, and help the management impact the result. It's very difficult for a passive investor with a small allocation to create alpha in the private market. So I don't want to make this seem like it's easily accessible to the average listener who might not have experience in this sector and is more interested in picking the right set of stocks that might outperform the S&P or the NASDAQ. But if you can do it, and you do have the resources to do it, and you have the experience of appraising management teams and opportunities, and you buy at the right price, you could have non-correlated returns that vastly exceed your investment landscape. It would then what's available in the public markets, where there are far more sophisticated hedge funds and big players that have enormous information asymmetry vis-a-vis you, the average retail investor. And so for us, that's just not a game that we play very often. And we much prefer to get in on the early rounds of a company where we understand the execution strategy, the management team, and how we can help them.
Wow, well, that's just great. Thank you so much for sharing those insights and that strategy. And yes, maybe not every investor watching can do all that today, but it's good information for them, good education, and it gives many of them something to aspire to be able to do once they have the capital to do so. Well, look, Doomberg, so many questions still, and just not enough time to get to them all. Definitely going to have you back on here. Thank you so much for all of these great in-depth answers that you've been providing our folks. For folks that have really enjoyed getting to know you through this interview and would like to follow you in your work, where should they go?
First of all, Adam, wholeheartedly agree. It's gone by way too quick, and look forward to coming back. Anytime you'll have us, we are very humbled by the invitation, and we're thrilled to come on. We can be found on Twitter at Doomberg T. T stands for Thomas or Terminal. Somebody is squatting on at Doomberg, and so we had to create a different name. And then most importantly for your listeners, if you enjoyed this conversation and you want to find out more or read some of our work, the predominant outlet for our content creation is doomberg.substack.com. We publish roughly twice a week, pretty well researched, well written, tightly edited pieces that are topical and we're averaging about 80 to 100,000 views per piece. We're about to cross 30,000 email subscribers in less than 9 months. We're thrilled by the response, and if you want to be part of that movement, come on over to doomberg.substack.com, sign up for your email. It's free today. We'll eventually go behind the paywall, but we're building a big audience and having a lot of fun doing it.
Oh, that's just fantastic. And Doomberg, when we edit this, I'll put up the URLs to your Twitter handle and to your Substack page there. Folks, Doomberg is my favorite weekly read. Highly encourage you guys to go sign up for that email. I do just want to close here by reading part of your philosophy, just because it really shows what a great organization you and the folks who run Doomberg are. We believe a key part of our success is our willingness to promote other aspiring independent writers and content creators. We do this by highlighting, building on, and linking to great work in our own pieces, retweeting material on Twitter, and freely exchanging tips and best practices for growing an audience in private conversations and direct messages. Our belief is that rising tide lifts all boats, and the exponential growth and demand for good content means there's more than enough audience for everybody who puts serious effort behind their work. We're playing a positive sum game. You know, as somebody who has followed your work, has benefited from you elevating some of the videos we've done here at Wealthion, I can't thank you enough, but also just show you how much I appreciate your role there in this industry as being a connector and uplifter. And it's both for content producers like myself, but also for everybody that's benefiting from reading your content. So Doomberg, thank you so much. I wish you all the best in the future with your continued meteoric rise, and look forward to having you on this channel again sometime soon.
Thrilled to be here. Thank you for the great words. It was a great pleasure. Happy to come back anytime, and congrats to you on your success as well, Adam. It's been a blast.
All right, well, now's the time on the program where we talk to the lead partners at New Harbor Financial, one of the endorsed financial advisors here at Wealthion. John and Mike, phenomenal discussion with Doomberg. I know a lot of what we talked about is near and dear to your guys' hearts. You guys totally have a very similar outlook in terms of the importance of resources to our future, especially energy. Mike, let's get started with you. What did you think?
I learned a lot from that interview, Adam. Thank you. He describes the environment that we're in right now as precarious. I think we agree with that completely. We're in a precarious economic environment. And if the economy and the markets are precarious, and if they should falter, God forbid, that means that that our lives, that the everyday life could become precarious ultimately. And that's really what we're gambling with now, because we've got such a large disconnect between the economy and the market. The economy of GDP, gross domestic product, is around $20 trillion a year. The market, stock market's around 50 trillion. So the largest gap we've ever seen. And so the Fed has put us here. And I really like what Doomberg said when they said that the Fed became politicized. When Powell buckled to the pressure under the Trump administration to lower interest rates, Trump was basically saying, you need to lower interest rates. Other countries are doing it. We need to do it more. Ultimately, Powell caved. And then, there was a Powell pivot that came even later, of course. I believe that was 2018. But the Fed became politicized. And when that happened, there was no looking back. It's clear to me now. And when I heard Doomberg say that, I was like, absolutely. The Fed is just another branch, like the Supreme Court and so many others. And that can't be a good thing for our freedom. And not that we can do much about it, but it's just part of why we're in such a dangerous place, because we're reliant on the Fed to backstop every move in the market. I like some of the things that Doomberg talked about in terms of investments. I'll just hit the high points and then let you and John hit some of the others. But Doomberg talked about saving in real things, property, gold and silver. We certainly agree with that. We'd like to talk a little bit more about gold, silver, and gold stocks later in this program, if you'll allow it, Adam, because they're starting to act very well.
Yeah, absolutely. It's been a heck of a run this past week.
Yeah, it has been. And lastly, he says that they've got a very small allocation to stocks, and they like investing in sweat equity or things that you can build on your own, like your own business. And he even talks about private equity. So overall, I thought it was a really great talk, well balanced, and enjoyed it very much.
Great, Mike. I've got lots to add to what you just said, but before I chime in, let me give John a chance to add his 2 cents here. John, what would you say beyond what Mike just said?
Yeah, Adam, I really like the the well-researched viewpoints, but also the balanced viewpoints. And what I mean by that, and you kind of caught on this with a little bit of play on their name. You asked if they spoke of there will be a time to be optimistic and bullish, and there will be a major boom. And you joked, perhaps you should change your name to Boomberg at that point and not Doomberg. And that speaks to, I think, you might say that people are bearish or pessimistic, get labeled with this perma, kind of qualifier. And what I found very refreshing is there's nothing perma about what they talked about there. It's a very observant and ultimately optimistic. I forget the actual verbiage they use, but they are optimistic about the human spirit or the human condition. I forget exactly what the terms were, and that's how we are. We sometimes get a little bit tired of hearing ourselves talk about the concerning market data that we see that is off the charts extreme, going back 100 years or so. But we know there will be times to be more optimistic and frankly, downright giddy, if I could use that word, because the conditions will have been cleared that have us so concerned today.
All right, yeah, and thanks for putting a highlight there on my dad joke about Doomberg. I got a lot of comments, a lot of flack in the comments for being that corny. But no, I agree. I think they're just pragmatic realists, very, very data dependent, as you mentioned, as we talked about in the interview. One of Doomberg's kind of competitive advantages to the rest of the field is they have a network of C-level executives that they talk to on a regular basis. So they're actually talking with the guys in the trenches who are seeing the real commercial data and then having to make decisions based on it in real time to run their businesses. So you don't really get as much closer to the pulse of the economy as who these guys are talking to. And when that data changes, then I think they'll change along with it. It's sort of like what we talked with John Hussman a few months back, where he was sort of lamenting he keeps getting put in the perma bear camp as well. And he just said, I just reflect, my analysis reflects what the numbers indicate. And the problem is they've just indicated so many bad tidings for so darn long, which but he says, look, as soon as the data changes, I'll change my tune too. So great. Well, look, one of the things that these guys really put a fine point on was the importance of resources to the economy. We spent most of the time talking about oil, but they also mentioned a whole other things, fertilizer and all sorts of other different types of important key commodities out there for both commerce, just as well for our own way of life. And, we sort of talked about the specter of, are there, going to be resource conflicts in the future? The day that we're recording this, there's still a lot of tension going on right now on the Ukraine side. And, at the end of the day, any kind of, military drum beating like that usually has resources at the heart of it, whether it's key ports or whether it's other type of resources there. So, I know that you guys at New Harbor, you are big fans of investing in hard assets, both in terms of the assets themselves and in terms of the companies that produce them. Mike, I'm coming back to you here. But as we get sort of further into 2002 here, we're going to talk about the gold mining producers in just a little bit. But, is your opinion still pretty supportive, as I just said, of commodities and commodity producers being an important part of a portfolio?
Absolutely. We think it should be a large part of a portfolio. We're seeing high relative strength in a lot of these sectors, commodities and commodity producers. In fact, just today, we added a new position. Just wrapped up the trade a little while ago in oil service stocks. Not a large position, a little under 10%, but many of your viewers probably have noticed that crude oil is up towards 95. But it's not the only commodity that's been trending upwards, but certainly oil has been leading the pack. And the relative strength of the oil service companies in particular looks very, very good, very attractive, a nice basing pattern in that chart, and it's now broken out. So we put a hedged position on. We sold a call option against it, like we often do, to bring in an extra income and to hedge the downside. And further with gold and silver look to finally be breaking out. Gold is right around 1900. solidly breaking out of that bullish triangle that we've been talking about for a long time. And silver too is following suit. And if you look at the gold and silver mining complex, let's just use GDX as a proxy, not as a specific recommendation, but take a look at the ETF GDX. It's crossed 35. And that's up from 29 just a couple weeks ago. So it's kind of like a stealth move. It really seems like it's for real this time. The notion that inflation is here is finally starting to seep into people's heads. I think permanently, the yield on the 10-year is up around 2% again. And, the Fed is serious about inflation, that type of thing. So yeah, it looks like gold is breaking out. It's not too late to own a position in gold here at 1900 if you don't have any already. But we like gold, silver, commodities, other things, including, like I just mentioned, oil service stocks as well.
Okay, great. All right. Well, thanks for the segue now into gold specifically. So you just mentioned, Mike, that today, while we're recording this, gold has just hit $1,900 an ounce. It's been a while since it's been back up here. It's been struggling for a long time to break above the sort of 1820 to 1850 range. It keeps getting whacked down into the mid 1700s. And then now over the past 2 weeks or so, we've finally seen this latest attempt break through the resistance in the 1800s, and now we're up at 1900. I normally would tell people, hey, this is, really exciting. This could be, the breakout movement we've all been waiting for. We've shown that wedge. I'll put it up here again from Crescat Capital, but you've mentioned it as well, Mike. So what I'm wondering, and John, I'll come to you for this, is how much of, the move to 1900 is due to the tensions between Russia and Ukraine right now? Because when the world gets nervous geopolitically, gold tends to do well. And tacking onto that question, we've had this nice run that Mike just talked about. That plus the additional geopolitical tensions, I guess, do you think we're kind of due here for some sort of pullback, either just because we've moved so far so fast, and or because Russia, if the situation de-escalates, there might be a pretty big crisis premium that comes off of gold here? I just want to sort of caution people not to get super excited that we're, running off to the 2000s from here, which we could do, but there are some reasons to expect that a pullback might be due in the relatively near future, I think.
Oh yeah, and we're the first, Adam, to say that forecasts are exactly that. We're shy to give forecasts. We just kind of think about scenarios and probabilities, and there's never a 0% probability of virtually anything. So in other words, yeah, this could be. So to answer your question, almost certainly there probably is some decent uplift in gold prices due to the tensions in Ukraine. In fact, the other day, where I think it was Monday actually of this week, where Russia at least seemed to make some moves to withdraw some troops and equipment, whether they were real or not, who knows? But gold pulled back pretty swiftly on that news. So yeah, there definitely and typically is a very pronounced relationship between gold prices and geopolitical tensions like that in the very short term. But you do have this very significant long-term breakout, technical breakout that is combined with a much larger fundamental picture that is supportive for commodities, gold included. So I almost would bifurcate the short-term influences of Ukraine and acknowledge that, yeah, that could certainly, if resolved in a peaceful or less concerning way in the near term, could have a chilling effect on the short-term prices for gold. But I think this move above these resistance levels that have been basing out for months, if not years, is real, and we're likely, even with a short-term pullback possibly in the cards, going to see some follow through to the upside. And in particular, we oftentimes will speak to the gold mining stocks themselves as having in effect a margin of safety already built into them, because their valuations relative to the price of metal still remain very, very compelling values. And to summarize what that means, even with gold prices staying the same or dropping, there still is fundamental and historical reasons why the price of the gold mining shares themselves could appreciate. There's definitely a lot of scenarios that can happen near and longer term, but we think the mid to longer term trend certainly almost certainly is a supportive one for higher prices ahead.
All right, Mike, I'm coming to you now. Just we've talked in the past about any asset class that you believe to be mispriced by the market. When it does get repriced, it tends to happen quite quickly, right? It tends to be more of an event than a process, and that's why we recommend that people, take their positions beforehand. Because if you wait too long, the repricing can quickly happen, and you miss it, or you're even worse, caught chasing the price. And it seems right now that the miners might, be getting repriced a little bit, which is great. I've looked at the miners in my portfolio. They've actually made up a lot of pretty much all their losses that they had taken over the past couple of quarters, and they're all nicely green again, which is great. So at New Harbor, you guys have, I think miners are still one of your more substantial positions. Are you guys planning any changes there? I know you said you just added some oil, but are you going to be adding, or are you just going to keep holding what you have, or are you going to start raising some of your put levels on these stocks so that you're putting in a higher bottom in case they should correct from here? What's going on with your mining position?
Yeah, we still believe clearly in the mining space, and it is a prominent holding in our portfolio and will continue to be. We don't expect that this is a short-term movement, although with the caveat that nobody knows the future. You're right that repricings often happen quickly. We've learned that throughout our careers, and oftentimes you'll see an asset double only to double again quickly. In fact, I heard some famous hedge fund managers say in the last year, and I can't remember who it was, but they said when they see a bubble, the smart thing to do is to jump into it and try to add to it. That's not what we're condoning, but it probably makes sense based on experience that price starts moving, it generally moves a little further before reversing. Again, we're not condoning any rash behavior, but just because gold miners have started to move a little bit, maybe 20% off the bottom, is, in our opinion, just the beginning. The technicals on gold itself looks like it could carry to much higher. If you look at a breakout of that bullish triangle, looks like gold could carry to 2,500 approximately. That should bring GDX above 50 from where it is currently 35. So yeah, we think there's a lot of room. Our advice would be to just take a position size that makes sense for your portfolio and stick with it here. So you said that your miners are in the green. That's only after quite a lot of quarters of being in the red, right? But for a new person that's entering that field today, they can buy at a very good price, and just use some common sense in terms of sizing and hold on to it.
Great. And, as we've talked about, I think for most people, just going after the beta by owning the major ETFs, probably a good idea. But for those folks that are willing to, put a little bit more discretionary capital at risk in trying to capture some of the alpha of the better players, this is one of those times where, if indeed this is a breakout to the upside, we should start seeing some mining stocks really start returning kind of just extremely attractive returns. And I'll say that I think that's conservative, if we get a true boom here. I want to remind folks that if you're looking for, if you're going to think of investing in individual mining stocks, we highly, highly recommend that you follow somebody who analyzes them as a full-time job. It's just like a lot of other speculative industries. There are a lot of players out there that are going to go nowhere, or maybe even go out of business. But the ones that do well can do phenomenally well. But they can be very hard to separate that wheat from the chaff yourself, especially if you're a relatively inexperienced investor in this space. I've interviewed Jeff Clark, precious metals and mining analyst from Gold Sober, a number of times, including just last week, where he revealed his own personal portfolio that he thinks is actually going to have enough alpha that it's going to dramatically outperform the major ETFs. It's the one that he calls GDX Jeff, which he has basically kind of put his personal brand at risk by saying, we're going to track that going forward versus the GDXJ ETF. And I just pinged him as we started this interview here. He said it's been a couple of days since he's checked the performance, but as of a couple of days ago, GDX Jeff was up 12.2% versus only 3.8% for GDXJ. So he's off to a good start. And folks, if you haven't watched that video yet where Jeff shares what those stocks are, explains why he's investing in each, you can go watch that right now for free over at wealthion.com/GDXJeff. All right, and as we wrap up here, John, I'm going to come back to you real quickly. At New Harbor, you guys talk to many clients, many people week after week after week, really have your finger on the pulse of what the average investor, like all the folks who are watching these videos, you are kind of wrestling with, hopes, dreams, fears, et cetera. What are you picking up right now, and do you have any general counsel that you can offer to today's viewers, given what you're seeing?
Yeah, well, of course, we do speak to real people, real clients that reach out to us with real life stories, and every one of those clients is different in their own unique way. But we find there's a commonality across all the clients that we speak to. Many of them come to a firm like us seeking counsel on money that they didn't fall into by accident. It was a result of their hard work and perhaps life's work, and they don't have much desire or frankly even ability to get it wrong when it comes to their nest eggs. This is their life, and a tragic setback in those financial assets could be traumatic to their obviously peace of mind, but also their life security. So we take those conversations very seriously and bring them back to the people and their unique situations. But the commonality there is, virtually everybody we talk to, when we speak to them and share perspectives that are grounded in data about how extreme markets presently are, they, by and large, the folks we talk to do want to err strongly on the side of caution, even though they know it's very frustrating and can be frustrating. That's what bubble markets do. They tire people out. They seduce people to take on risks that they know or believe they shouldn't. And so we're having lots of conversations around that. I will tell you that the tone with the conversations, folks are more seeing and feeling that things are concerning, whereas late last year when the markets were, seemingly only going up, that plays tricks with people's psychology, ours included. If we didn't have the data to kind of ground us, we'd be losing our wits most days. So the conversations are much more about, hey, I want to be very safe. I want to make sure that I can ride out what seems like a very uncertain period of time right now, so that we can not only be okay, but that we'll be intact to, hopefully take advantage of prudent growth opportunities after whatever patch of volatility we're in store for here.
All right. Well, thanks so much for that. I think it's really helpful for these viewers to see what the people that you're talking to, regularly are thinking, because I'm sure most of them are thinking the same thing. So it sounds like you're saying kind of the FOMO that we were seeing at the end of last year is now kind of being replaced with the fear of being wrong or the fear of loss. And of course, this is big reason why we bring you guys on week after week, is to remind folks that as investors, our emotions are often our very worst enemies, and they force us to make decisions based upon heightened emotions rather than just pure logic. And of course, having an advisor can be super useful to removing that emotional component and keeping us on track with the logic of the plan we put together. Folks, if you want to have a conversation with an experienced financial advisor that can help you do that, we highly recommend you do that wherever you find a great advisor. If you don't have one handy or having trouble finding one, John and Mike and their team at New Harbor, they offer free consultations, no strings attached. Again, free, no expectation to work with them. If you want to have a conversation with them where they'll just review your personal situation and tell you what they think you should do, stick around at the end of this video. We tell you how to do that. All right, guys, well, as we wrap up here, folks, if you haven't yet, again, I highly recommend going and subscribing to Doomberg's free newsletter over at doomberg.substack.com. Again, if you haven't yet watched the GDF, Jeff Clark's mining stock recommendations videos, go get that at wealthion.com/GDXJeff. And guys, whatever happens from here, we will be tracking it week after week after week. I look forward to seeing you guys next week to see what it brings, hopefully even higher prices for gold. Thanks so much for watching, folks, and everybody else. Before you hop away, if you don't mind supporting this channel, just hit the like button. And if you haven't already, hit the subscribe button as well as that little bell icon right next to it. Thanks so much, John and Mike, for joining me. Everybody else, thanks for watching.
Adam, thanks again for having us. Another great conversation, and we look forward to next week.
It's a great conversation, Adam. Thanks. We'll see you soon.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.